Pretty good day in the market today. It closed on a strong note, fueled mainly by the falling Treasury yields and optimism around earnings resilience. We've seen the S&P 500 reach yet another record high, closing in at 0.83% by market close. Dow up 0.77%. The Nasdaq almost up 1%, leading in the territory of 0.98% by market close. And this was driven by strength in big tech. Think names like Alphabet, Apple, Dell. All of these companies moved higher, and really highlight Google here because Google in particular is still riding its momentum from its earlier antitrust victory from this week. So according to Chris Gallipew of Franklin Templeton, history is on this bull market side. So when the Fed goes from pausing rate cuts and then resumes cutting rates, the S&P 500 has tended to rally over the next following year. And what gives this leg higher credibility is the broad-based earnings strength we saw in the second quarter of this year. So profits weren't necessarily concentrated in just a handful of names, but rather spread out across multiple sectors, showing true market breadth is very strong. So that's seen as a good sign as far as this rally goes. Now, the rally came alongside a notable move in the bond market. The 10-year Treasury yield fell to its lowest level since April, falling to 4.176%. Now, why does this even matter in the first place? The 10-year Treasury yield is the central to equity valuations. Mortgage rates tend to follow them. Corporate borrowing costs, while the 30-year yield has drawn attention to flirting with multi-year highs, and leads to strategists like Gallup arguing that the 10-year Treasury yield is the true benchmark to watch for the stock market impact. But still, the long-term yields remain under pressure due mainly to the concerns over inflation, possibly from these tariffs, the ballooning U.S. deficit, and questions about the sustainability of government debt issuance. Without tariff revenues, which courts may soon rule illegal overall, the government may need to lean even harder on Treasury issuance, potentially steepening the yield curve even further, hence raising the cost of borrowing money. Now, amid all of this, retirement accounts have quietly surged and people are getting rich. So Fidelity reports the 401k millionaires today record 595,000 in the second quarter of this year. The median millionaire balances are around 1.4 million, and the average saver in the group has been contributing for around 25 years, and during the dot-com bust, the 2008 financial crisis, and even during that pandemic period. It's mainly a reminder that while the headlines swing day to day and there's a ton of scary articles that come out, disciplined long-term saving continues to pay off for many Americans, at least in the past, is what we've seen. But on the other hand, the labor market continues to cool, is what today kind of revealed, and that's where the story really turns in this video. So ADP's private sector report showed just 54,000 jobs added in August, which was well below the 75,000 expected and down sharply from the 104,000 in July. Then we've seen weekly jobless claims ticked up to 237,000, which was the highest level we've seen since June. Even though continuing claims edged down slightly lower, the underlying story here is that it's taken a little bit longer for laid off workers to find new jobs, which isn't necessarily new news here. The ADP's data is often found as an unreliable predictor of the official government jobs report, which we get tomorrow, but both measures have been trending the same way, which lead to slower and weaker hiring since May of this year. Now, Neela Richardson, which is ADP's chief economist, pointed to labor shortages, skittish consumers, and AI disruptions as possible reasons for the slowdown that we're seeing. But that cooling labor market is front and center for the Federal Reserve. We've seen John Williams come out. He's of the New York Fed and a close ally of Jerome Powell, the Fed chair. And what Williams said is that he doesn't see tariffs creating broad inflation spillovers. With inflation risk easing, he argued the bigger concern is that keeping policy too restrictive for too long could harm the job market, and it's unnecessary. So his baseline forecast sees unemployment rising gradually to around 4.5% next year. I believe we're at like 4.2 or 4.3% this year. Chris Waller, one of the Fed's more outspoken governors, is calling not just for a rate cut at that September 17th meeting, but for several multiple cuts over the next 3 to 6 months. And Waller warned that once the labor market turns, it turns bad very quickly, making it critical to act preemptively and really get ahead of that. And then on the other end, we've seen Raphael Bostic, president of the Atlanta Fed. He's more cautious. He said he's comfortable with just one cut this year unless the Friday's jobs report shows a much weaker labor market than expected. But if it came in with strong jobs numbers, maybe even he supports not cutting at all and is okay with no cuts this year. Then Alberto Mussolini, the St. Louis Fed, said he still sees relative health in the labor market, but acknowledged rising downside risks. But together, these Fed voices show a Fed that's divided but leaning towards action, at least some type of action. Now, that brings us to the next big moment from the BLS, the Bureau of Labor Statistics August jobs report, which is due out tomorrow. Now, economists are expecting 75,000 jobs to be added. That lands us a little bit higher than 73,000 that we seen in July. Unemployment rate rising to 4.3%, up from 4.2%. So yeah, we're sitting at that 4.2% figure for unemployment. Hourly wages up 0.3% month over month, to 3.7% year over year, cooling slightly from the prior 3.9%. And the stakes are really high, not just because of the numbers, but because of the politics that surround these numbers. So this will be the first jobs report since President Trump fired the BLS commissioner, accusing the agency of manipulating the data. Now, while experts stress that large revisions are normal, the White House pressure campaign has made the reliability of labor data a political flashpoint and even brought more of the eyes of the spotlight on this data. So markets will be watching closely to see whether the job growth is concentrated in narrow industries like healthcare, for example, or broader across the entire economy. If wage growth is cooling or keeps cooling and signaling less inflationary pressure, whether the revisions trend continues and we're getting these huge misses on the data that we thought was once this number and it's way lower than what we thought, or even higher. And since earlier months were revised sharply downward is the reason why there's a lot of attention. And then if the report shows ongoing weakness, it could cement expectations for the September cut that we're watching. So the bigger picture here, there's stocks remaining resilient with broad earnings and tech leadership driving fresh highs. The bond market signaling both relief from the falling 10-year Treasury yields and a concern because there's a steepening curve with these deficit fears. And then the labor market, highlight, capital, underline. This one, the Fed officials are openly debating how quickly to respond to these labor market reactions. And then the jobs report tomorrow could determine whether the Fed makes its first rate cut or resume cutting rates in 2025 in just 2 weeks at that September 17th meeting. But history suggests when the Fed resumes cutting after a pause, equities could often rally. Now, the history doesn't always repeat itself. Sometimes it rhymes though, but this cycle is complicated by the tariffs, the debt dynamics, and politics that are anything but ordinary. So what we are right now is uncertain. Who knows what could happen? All I know is that I'll be here tomorrow to talk about what's going on, everybody. Thanks for hanging out with me, and I'll see you tomorrow.